But the net, the bottom line here, the Fed was created with two jobs. I mean, literally in the creation of the Federal Reserve was these two concerns. One was maintaining interest rates at a low level, and typically the goal is below 3%. And the second was maintaining high levels of employment, low levels of unemployment, trying to keep unemployment below 3%, below 4% anyway, trying to keep inflation below 4%. And you go back to the 1970s, back when the Fed, Paul Volcker, jacked interest rates up to 13, 15, 18%. I mean, they really, really went up high. And it was the end of an era that worked out really, really well for working people and did not work out well for really rich people. And the whole Thatcher-Reagan revolution had to do in large part, or was fueled by, the Fed messing with the economy. And so and the reason why is very simple. Interest rates are the cost of money. It's just, what is the cost of money? And so as interest rates go up, money becomes more expensive. If money becomes more expensive, then expanding a factory becomes more expensive. Paying your people becomes more expensive. It affects the value of the dollar relative to other currencies and other commodities as well. And so you get this whole kind of basically, okay, let's just go through the list, actually, of things that happen as a result of interest rate changes. If you cut interest rates, you raise the rate of growth of the economy. If you raise interest rates, you slow down the growth of the economy. In the process of slowing down the growth of the economy, you're also slowing down investment, you're slowing down consumption, and, so people are buying less. Now, there's this thing called aggregate demand, which is what people buy. That's what drives an economy. Supply side economics, the whole Reagan thing, it's not only nonsense, it's disproven nonsense. It's beyond stupid. I realize there are still some Republicans who hang on to it, but it's crazy stuff. And so as interest rates go up, the general economic activity goes down. As general economic activity goes down, unemployment increases, employment decreases. And so the average working person is hurt. And as unemployment goes up, guess what goes down? Wages, right? Less demand for labor. So, you get lower inflation, but you also get lower growth. It also strengthens the dollar when you raise interest rates. And the reason why it strengthens the dollar is because the safest place to invest your money in the world right now is U.S. Treasury bills. And treasuries pay an interest rate that is defined in large part by the Fed. And so if the Fed raises interest rates, see, people want to put their money, I'm talking about really, really rich people and institutional investors. We're talking billions and trillions of dollars here. People want to put their money someplace where it's going to get a good rate of return. And a 1% rate of return is not very good. So as we raise our interest rates relative to other countries, then what happens is that people take their money out of those countries, out of those currencies, convert it into dollars so that they can buy treasury bills and bonds. And the result of that is, more demand for dollars, because you have to have the dollars to buy the treasuries. More demand for dollars makes the dollar stronger. Now, what happens when the dollar is stronger? It makes the cost of our exports more expensive and the cost of imports cheaper, which also serves to, by reducing exports and increasing imports, also serves to hurt workers. You with me on this? So again, raising interest rates hurts workers all these different ways. It strengthens the dollar, It reduces exports. It increases imports. More cheap stuff in Walmart from Malaysia and China and Vietnam. Less stuff made in the United States. All these kind of things. And also, as interest rates go up, asset prices go up. The price of gold goes up. The price of oil goes up. The price of copper goes up. You know, just very, very straightforward stuff like that. So unemployment rises, GDP falls, inflation, the stock market will fall when interest rates go up. So, you know, when Yellen is talking about raising interest rates, well, you know, in part this is because it's harder for, you know, most major American corporations are operating with a fair amount of debt, and now the price of that debt goes up, so the value of them goes down. Borrowers lose, but rich people who lend money win when interest rates go up. So again, I mean, so far I've been talking about this from the point of view of working people. But if you look at it from the point of view of the 1%, interest rates going up is a benefit to them because, you know, they can make more money loaning money out. And, you know, as with higher interest rates, exporters lose, importers win. And so the net of all this, this is sort of a interest rates 101. And the reason I'm bringing this up is that there's a very good chance that sometime this fall or this winter, and I'm guessing it's probably going to be after the November elections, but we'll see, that the Fed is actually going to start raising interest rates because they're coming, Janet Yellen and the Fed are coming under incredible pressure from the very, very wealthy to return us to an economy that screws working people and helps rich people get rich, and that it's more profitable for the banksters, and that means higher interest rates. And, you know, I mean, Volcker was more than willing to do it. Alan Greenspan was enthusiastic about doing it. In my book Screwed, I quote Greenspan out of the Wall Street Journal, and I think it was 1998. He said that he viewed his job, I'm paraphrasing here from memory, but he said, where's the effect of, I view one of the more important parts of my job is to maintain a certain minimum level of worker insecurity to prevent what he called wage inflation. Now, he didn't worry about wage inflation among the CEO class. That was fine with him. But wage inflation among the vast workers, in other words, people getting pay raises, can't have that. So every time the economy started heating up to the point where there was demand for labor that exceeded the labor supply, which causes wages to go up, Greenspan would raise interest rates, which would cool down the economy, which would cause companies to lay people off. And you know, it was just like this dance that Greenspan did to help out the rich Republican donors and screw the workers. So I realize this is this may seem very wonky, but the net here is interest rates actually count. They count a lot. They have a big impact on you and me. They influence our economy. They influence the value of our currency. They influence our investments. They influence our IRAs and 401ks. They influence pretty much everything. And right now, with super low interest rates, you could argue that we're below where we should be. This is part of the hold the economy together with bailing wire strategy.
This is the Thom Hartmann Program.
Which is why, as I pointed out in the crash of 2016, I'm expecting the problems, shall we say, to occur probably after the election.